I was wondering if a buyer's agent fees for an investment property are tax deductible. You can't put a value on how important protecting your property and maintaining its value is, especially when you come to sell, and then you're going to realise exactly how much difference it could have been made if it was a well-presented, well-maintained property. I always say to people, buy the best quality of property that you can afford, but if it's going to take too long to jump up into that next price point, you're better off getting into what you can when you can.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jared Mann.
G'day and welcome to a Q&A episode where I'm going into some of the questions getting asked on the Perth Property Investment Facebook group. And if you're not already a member, head on over to Facebook, search Perth Property Investment and join in the conversations. Post any questions in there, and always good to see people throwing in their opinions to help others. So let's go into the first question I've chosen, which I think will help others by hearing it as well, was: Hi, I was wondering if a buyer's agent fees for an investment property are tax deductible. Now, of course, I'm no accountant. I'm not here to give taxation advice. I suggest that you speak to your own accountant about this. But from what I understand and how my accountants treated things in the past is that, like a sales agent's fee when you're selling a property, a buyer's agent fee when you're buying a property would be added to the overall cost base of the property, along with your transfer duty and other purchase costs. And that will be what is used to then later calculate any capital gains tax that's payable. So it is, I guess, offsettable against future capital gains, but it's not deductible against any other tax that you'd have to pay, income tax along the way, so to speak. So can be offset, is included in the cost base, and then later on when you sell for a profit, you take your selling price, you minus off your cost base that's worked out, including the buying costs, the selling costs, the buyer's agent fees, the sales agent fees, and you then, if you've held it for more than a year, you get a 50% reduction in that tax, and then you pay it at your marginal rate. So do confirm all of that with your accountant, and that's just my layman's opinion of what I've seen happen with my buyer's agent fees when I pay for them. And I have used buyer's agents in other states when I've purchased all the time. I find it to be, there's no better thing than having someone on the ground that knows what they're doing. I also like having that independent person that to hold me back from when I get overly emotional about wanting to win and secure a property. I can be objective when it comes to our clients when we're representing them as a buyer's agent, but I find it very hard when I'm just myself, and takes all the emotion out of it when you've got that other person who's an expert and can really do all the diligence, knows the area like the back of their hand, and can have that rapport and a relationship with the sales agent so that you can get the inside track, which is especially important in a market like this, which is very hot. And you need to have those relationships working hard for you to purchase a property at the moment. When you're just one of many, you want to stand out and have that relationship cut through to give you the edge. And that's what we're doing for clients here. Did get a little off track on that one. Don't get me started talking about buyer's agents here. We certainly love it around here. So now, next question, is subdivision stacking up at the moment? And what I'd say to this is it always needs to be looked at case by case. And the best place to usually start is you can reach out to me for some updated sale appraisals. So look at what the property overall is currently worth now. Look at what the end product would be worth. And it is hard to appraise that end product at the moment because so little has been developed lately. But we'd look through to what the land itself might be worth if you are going to subdivide it, what a villa or a house that you'd build on the land would be worth. And when you've got those figures, then you can start to see, is there going to be much potential fat in this? Now, the key cost that you need then is an estimate for the building cost, an estimate for the site works, and you want to factor in your buying costs and any subdivision cost. So once you get those high-level appraisals, if it's checking out on the back of an envelope, then you can go deeper, involve a subdivision expert to do a feasibility. You can cross-check the values that I've given you for those end products that you create, cross-check it with whatever they put into their feasibility. You could even go and get an appraisal from a local agent. The deeper you get down to really get as many points of reference to ensure it stacks up overall. And remember, we're looking through to what are today's values. So while there should be lots of growth ahead, we can't count on it, because if the market turns around and has a spanner thrown into it with a global event, you don't want to be caught, with your pants down and having hoped for value to be gained. You really need to just work off of today's prices. And if things do keep going up, that's a fabulous bonus, and you'll only make more profit on your end product when you get there. But best to factor in on today. And you really want to be looking through to, is this going to give you at least a 15% profit margin on total expenses? Ideally, might go as low as 12 in this sort of market, 12%, because it is all likely to keep going up. And I've seen some people do them at 10%, and it depends on your overall reasons to develop it as well. So if you're doing it purely just to profit and sell them off, you really need to obviously factor in your selling costs then as well, any GST payable. Look at what you're actually left with after tax. You want to factor in your holding cost as well, so this whole project. So other reasons that you might be developing is the property could just be costing you so much to hold in its unimproved state at the moment. And a lot of people, as they're nearing retirement, develop properties that they've been sitting on for a while. And a lot of my properties are developable and subdividable too. So I intend to develop them as I get closer to wanting to convert the overall portfolio to more of an income focus. At the moment, I'm happy to carry the negative cash flow, and they're slowly becoming more positive as rents go up. But at some point I will develop them. So the big reason for those people is really yes, if it makes a 10% gain in its overall value, that's great. But they also want to convert what could be a negative cash flowing asset into a positive cash flowing asset. And especially when you get the extra rents on the property, you get you got a new property to rent out, you're going to get a premium for that. You've got high depreciation that you can offset against your tax too. So it really converts that asset into a much more cash flow friendly asset. And that's a really great idea to do when you're taking into the income phase. And if you're not also having to factor in selling costs, well, again, you get more margin in the overall thing left to you. Many people also revalue on completion to pull some cash out without selling, just refinancing. So there's lots of options there, and it is going to start to become more viable. And it's something that I think investors should keep an eye on, because as established prices continue to move up, their relative price to building a new property, the gap is closing, and it's starting to make more sense to develop with time frames and build costs having stabilized. And if you are looking to sell or rent either of those things, there's going to be strong demand from both the sale market and the rental market. So rather long answer there as well, but I wanted to go into some of the detail that I haven't covered in recent episodes as to how to really look at whether to develop a property or not. And happy to help if you do want some appraisal input on anything. Next question. It's generally advised to stay clear of buying a unit where there's 90 other units in the block. This would likely reduce capital gains, but if it's really good for cash flow in a short-term rental, is that okay? I'm looking to buy my next short-term rental, but unsure if I should still stick to similar principles again, buying where there's only 3 to 5 units rather than an apartment in a high density building. So what I would do is, yes, you're right. When you buy in a high density complex, you're going to have a lesser land component. You're going to likely have less capital growth, more rental yield, And I would take a step back if I was you and ask myself, well, why are you aiming to focus on rental yield now? Are you near retirement? Are you trying to replace your income sooner than you need to? Is $100 or $200 a month or whatever the amount is that's going to be positive cash flow, is that really going to change your life and change your world and help you have more choices? Or would you be better off growing your capital base first, getting that to a considerable size? And the best way to grow your capital base is through a focus on capital growth, not a focus on cash flow. And a lot of people get sort of distracted with that allure of, oh yeah, I'm making a little bit extra per week in cash flow, but yeah, it's not going to change their world. It's not going to get them out of where they're at. So, but the definitive way to see what the actual trade-off is I would look back at what has been the average growth rate for each of the types of properties that you're looking to buy. Look at the specific property, find the oldest known sale price, find out what it's currently valued for today, use a compound interest calculator so you can back calculate what the average annual growth rate has been for as far back as you can find that reliable selling price. And if there isn't a price for the specific property going back very far, you could look at other properties in the group, find their past sale prices as well, calculate the average growth rates for them. That starts to paint a bit of a picture as to, okay, well, properties in this group have all grown by this sort of amount over these time periods. And it's ideal if you can really be looking at least 20 plus years back, because then you're going to involve a number of cycles, and units are only really just coming up to growing in the current cycle. So it's not fair to assess them compared to houses for growth rate until they've been through the current cycle over the next 2 to 3 years, and then their average growth rates over the longer term will appear much higher as well, because they're due for catching up, as I've discussed in previous episodes lately. So I would compare that to looking at your other alternatives. Do that for each of the apartment types. Obviously, if you're buying into a newer group, you're not going to have that historical performance to look back on, and you'd sort of be hoping for what the median unit price average has been for the suburb. And generally speaking, if you're buying into a group that has, lower density, you're also going to get far less politics and the potential for strata hassles as well, which is a huge one. So it's not just all about growth and rental yield, it's about the hassle that an individual property is going to provide. So you really need to look deeper into the AGM meeting minutes, the financials, see what the health of that strata group is. Is there a whole bunch of issues being raised continuously in the AGMs that aren't being addressed? Is there some upsettedness in the group, and is the strata manager not doing their job? Is the group do they have a lot of expensive items that they keep addressing that keep coming up? And what's on the 10-year maintenance plan? Is there some big items coming up that are really going to eat into your returns and increase the strata fees beyond what you might even be able to pay, as some people find, so they don't even have the cash flow to pay for that? So there's a lot of traps when you are looking at strata properties, and you need to look much deeper to see that they fully stack up, because you're looking to buy a property for cash flow. Imagine if you get a 10 or 20k special levy raise for doing the roof. That's going to kill your cash flow for a number of years and completely be against that goal of yours. So hopefully that helps, gives you some things to think about. On to the next question. Hi, I'm looking for some advice. Can anyone give me an idea of how much property management fees typically run in Perth? And they're asking about the Baldivis area. Any insights would be greatly appreciated. Thanks in advance. So Baldivis, if you don't know where it is, it's one of the suburbs very far south, just off of the freeway. And look, typically property management fees are going to be very similar across the whole of Perth. So they're going to be no different here. There's the low service discount managers that generally start at 7 to 10% plus GST, and some of them are all inclusive of this. So then there's the typical real estate agency in an area, think Ray White's, LJ Hookers, etc., and they usually charge 8 to 9% plus GST for their management fee. And then they have other ancillary fees that they charge for. So the leasing fee, usually 2 weeks rent plus GST, routine inspection fees, final bond inspections, and most of them have a monthly admin or monthly service charge for subscriptions and stuff. So those are the main sort of fees that you can expect. That's the sort of typical local real estate agent. And then there's property management specialists with highly experienced managers that are typically at the upper end of those fee ranges that I just mentioned, usually on slightly, towards the upper end of what the local real estate agents in the areas charge. And typically with all of this, you get what you pay for, and property management's no different. So a specialist can pay for themselves. Ultimately, if you have a good manager, they'll save you a lot more in maintenance because they'll have well-priced trades. They'll keep on top of things. They'll prevent small issues becoming bigger ones. They're going to save you a lot of hassle and effort, not needing to manage your manager to manage the property. And you should never have to manage your manager if they're doing their job. You want that sleep at night factor where you just don't have to worry about your properties. You can set and forget. And that's hard to put a price on what that's worth. You want your property to be protected. So we take over properties all the time, and the property condition report that's been done is very basic and won't actually stand up in court, and is not thorough enough for even us to then use to refer back to. So we do a very comprehensive property condition report, and then our reporting along the way on the routine inspections is very deep and thorough too, because we want to prevent those small issues becoming bigger ones and nip them in the bud along the way, rather than having them build up over time and then have the property value degrade. And we see many owners where we've taken over a management, they come and look at the property for the first time, seeing how the outgoing manager that we've taken over has left things. And it could be 5-10 years since they've previously seen it. And many of them are very shocked at how much that property is degraded over time, and it's all too late to go back on past tenants, to go back on the property manager who in most cases just washes their hands of it. So you can't put a value on how important protecting your property and maintaining its value is, especially when you come to sell, and then you're going to realize exactly how much difference it could have been made if it was a well-presented, well-maintained property. So how else can they save you money and add value? Well, they can also minimize the vacancy. And at the moment, it is starting to become a little more difficult to rent properties in certain areas, because a lot of investors are buying in certain areas at any one time. There could be 10, 15 other 3x1s on the market, all quite similar to yours. And we're finding that we're having to work really hard in certain suburbs. The vacancy rate is tipping up. So that's the first sort of signs that we've seen of that. And that's because investors are buying in some areas much more than others. And especially in some of the outer areas like Baldivis and Alkimos, we're starting to get the first sort of new builds coming on that are competing with the established stock again. So these people would have started building, 12, 18 months ago. They built them to rent them out, or they've had their plans changed and are now renting them out. And we're just finding that, we have to be very sharp on our price. We have to set multiple viewings per week. We have to have our marketing on point. We have to have a walkthrough video, really great photos. We need to really go deeper to find people's feedback and see if we're on track for price, see what the online views has been over the last week, and really troubleshoot and work these things around again when we haven't had to do that for quite a while. So vacancy is going to become, more of a factor to minimize as our market does start to go through some changes. And that's not happening across the board yet. It's just happening in certain selective suburbs. So if you are buying in areas, I'd be looking through to what the actual vacancy rate is and how many properties are online and being marketed that are similar to yours, so that you can get a bit of a heads up before you hit the rental market as to how aggressive to be with your price, or how realistic and sharp you need to be with your price to attract that market, the rental market. And of course, the final thing a good property manager is going to do is keep rents in line with the current market. And you might say, oh, isn't that an obvious thing? Why wouldn't they keep it in line with the market? Because they get a management fee and surely they'd want to get paid more. But no, every month when we take over properties under management, I'd say the majority of them are under rented and they're not kept in line with market. And the other property managers, for whatever reason, they just don't have the processes. They might be managing too many properties. They're not having what they perceive as difficult conversations to renew the rent and keep it in line with market. And this is especially going to be important with the changes to the Residential Tenancies Act, now making it so that we can only increase the rent once a year. We really want to be pushing and maximising the rents that we are increasing to now at the moment, because we won't be able to revisit that for a further year. So that in itself can have a good property manager pay for themselves. So there's so many areas. When you go deeper, when you're an experienced investor, you know the value that a great property manager can add. And that's one of our specialties here at Investors Edge. We do it with an investment mindset. We've got some, crazy guarantees. Does your property manager have a ridiculously responsive guarantee where if they don't return calls and emails in the same day, they'll pay you $100? That's probably our favourite guarantee out of the four, and we certainly live by that. So, of course, there's always a place for those discount agents where people don't want to pay the extra. What is worth noting is that property management fees are tax deductible. So unlike the buyer's agent fee, which I mentioned that adds to your tax base and comes off of your capital gains tax at the end, your property management fees can be tax deductible along the way, offset against the income tax that you'd need to pay for the rent on the property. And when you look at the after-tax cost, you're getting 30 to 50% back from the government in most cases, depending on your marginal tax rate. So really, it's a subsidy from the government to ensure that your property's managed really well and that you've got peace of mind and your returns are looked after. Final note I wanted to mention on property management is when I was starting out 16 years ago, I had 4 properties at the time and they were just being horribly managed by different managers. I changed around managers many times to try and find good ones. The actual person that was managing my property changed around many times, because it still happens in Perth all the time now with staff leaving and changing and moving here and there. Thankfully, my team are really solid and we've got such a great team that have been with me a long time, and very grateful for the people that we have delivering our service, our team that all have generally at least 5 years plus years experience. They all have, know what it's like to be a homeowner and investor themselves as well, and they bring that mindset to looking after your property as if it was their own. So all very important. But thinking back to when I was starting out, I nearly sold my properties and gave it all away because my property managers were doing such a bad job, and I thought to myself, gee, like if investing's this hard, no one ever told me about how hard it all can be when you've got a vacant property, when your property's getting damaged, when you're having issues, contacting your manager and not hearing back from them, and leaving countless voicemails and emails and still not hearing. So I nearly gave it all away, but when I couldn't find a property manager that could do an amazing job with that investment mindset, that's what led to me starting Investors Edge, and that was 16 odd years ago. It's crazy to see how far we've come. We now have over 1,020 properties across the whole of Perth, from Mandurah in the south up to Alkimos in the north, and we've got a team of 11 or 12 fabulous property managers that all do such an amazing job. And you can check us out on Google and read all the reviews and see all our awards and stuff, and I'm sure if you're not already a client of ours, we can see if we can help. Next question. Hoping to buy my second investment property, but have only got approval to buy something up to 400k, so only enough to buy an apartment or unit. Surprised how much strata is. I think they're referring to the strata fees. Is it still worth buying, do you think? Wondering whether to just keep paying down my house instead. So it is worth weighing up whether it's worth getting into the market or whether your money's better left in your offset account. If it's in your offset account, you're going to be saving probably 6 to 6.5% per annum on your loan interest. You don't obviously have any leverage in that money. It's just offsetting dollar for dollar. So you can probably put a price on that saving. If you're looking to buy and you're putting 100k into this purchase, I'm not sure exactly what your deposit is, but let's just talk round numbers. So 100k in your offset's going to save you $6,500 a year, let's say. That was at 6.5% interest. Now, I've mentioned in past episode how undervalued apartments and units are. I think there's an opportunity in the market at the moment to be purchasing and have some significant increases. Like I think the median house price for units is probably going to end up at 600 or 700K. We're probably going to end up at 900 to $1 million for houses. Even then, that gap would be quite large. And at the moment, there's a 200K gap between units and houses, which is the largest gap that there's ever been. So arguably, units are still going to go much higher, especially if houses go to 900 to $1 million. So I would look at what is your ability to save? What is the bottleneck for you at the moment? Is it that you need more deposit, or is it that your borrowing capacity is limited and that's holding you back from getting into a higher price point? If it's your deposit, you could look at borrowing up to 90% and paying lender's mortgage insurance, having that wrapped into the loan, and that might help you get into other price points. If it's your borrowing capacity, well, the only thing that's really going to solve that is increasing your income and or, making sure that you don't have any personal debts and have your credit cards at a low level so that that's not impacting your borrowing capacity at all either. So work on increasing your income. I mean, we should all be looking to do that to get more borrowing capacity for investing, and ultimately that's going to be a big bottleneck for a lot of people. So we all only have a limited borrowing capacity, so we need to make the best use of it. So I would look at what is the limiting factor. Is it your deposit? Is it your borrowing capacity? How likely either of those things going to be to change soon? So if it's going to take a long time to save up more of a deposit, you look at what your monthly savings are, you look at how long it's going to take, you look at what you said it was second investment property. Can you go and get equity from the first investment property? And how long might it take for that to increase? If the market's going up 10 grand a month, you might be able to wait 4 or 5 months more, get more equity in that, combine that with savings, and get into a more attractive price point. Because ultimately, I always say to people, buy the best quality of property that you can afford. But if it's going to take too long to jump up into that next price point, you're better off getting into what you can when you can. And I think when you do your calculations and you look at the catch-up growth that's going to be likely ahead for the unit market, you look at, many of them are at a 7 to 7.5% rental yield. Even when you do take out strata fees, you need to look through to the strata fees. You need to look through to what's the net return that you're left with and how much that property is going to cost you to hold. But even when you look through to those things, it should be fairly neutrally geared, because there's going to be a decent amount of depreciation on the property as well, depending on the age, of course. So all of those things should be considered to see if it's going to take too long. I would be looking to purchase now and get in for what you can. You take the same sort of approach as you do to selecting a house, and we use our trifecta review where we look at the suburb selection, the area, and the property, and we're looking for a history of strong growth for the suburb. We're looking for strongly predicted short-term growth as well. We're then going deeper into the area and other factors that affect that. And then when we look at the property, we're looking at how rentable is it, how saleable is it, what's the prices for each of those, what's its historical growth rate been for that individual property. And we do all the other checks to make sure there's no factors outside of things that would negatively affect its rentability or saleability, especially in a down market, because when things turn around, you don't want to have a property that has a strong negative factor, because boy, oh boy, people are going to be in some shocks because they've made compromises now that won't stack up later. So hopefully that answers, or at least gives you some factors to consider when deciding if this is right for you or not. Next one, I bought my first investment property and I was wondering your thoughts about landlord insurance. What company do you suggest, and anything special I need to cover? So a big disclaimer here, I'm not an insurance broker. I'm not licensed to give insurance advice. I'm just a investor talking about what I do personally and giving you some of the thoughts behind it. So this person's asking about landlord insurance. Now, a lot of the main building insurers offer a landlord policy where it can include the things that cover malicious damage, loss of rent, other parts that are part of the landlord the specific tenant side of things. Now, I always suggest you go with a specialist insurer, and there is benefits in having your policy separate to your main building insurance policy too, because if you go and make a claim on your landlord insurance, it's not likely to affect your main building insurance premium either. And we've found over time that the specialist landlord insurers are much more open to honouring claims. They've got a lot more comprehensive policies where they cover more. And having been in the property management side of things now for 16 years, we've seen that some of the better insurers that are worth checking out are the three that I personally use is Property Insurance Plus or PI Plus, EBM, or Terry Shear. So I would check out those three as a starting point. Do your own due diligence, speak to an insurance broker if you want specialist professional input. I'm not licensed to suggest any of those things, but that's what I use myself. So hopefully today's episode has been helpful and added to your knowledge bank. If you're not already a member of Perth Property Investment Facebook group, head on over and join in the conversations. And if this episode has been of value, I'd really appreciate you posting a quick rating or review on Spotify and iTunes. It helps us get found and reach more listeners. More listeners equals bigger show, which helps me get guests and better guests for you as well. So looking forward to some of the upcoming episodes, and I'll catch you on the next one. See ya. Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.